Happy Memorial Day, everybody. The time is on the Pacific Standard Time. It's 1:47 p.m. The date is 5/28, 2018. What we have here is a daily chart on the S&P 500. And the S&P 500 had gone into a correction from the January highs over here at 28.71. Now we had a big correction. We came up, we rolled back, hit that beige line as a 100-day moving average. But then here was that second reversal from this point here back down to these lows, and basically we had undercut all of the simple day moving averages. 27.10 on a 100-day, 26.73 is the 50-day, the 10-day is 27.23.6, and the 20-day simple moving average at 26.98. Now, the whole movement has been done on lower volume. And I'm going to just let you know that we had a series of lower highs in the S&P. We had where it started. This was a lower high. That was a lower high reversal. We hit the bottoms down here where we attempted to rally just to set up a daily doji on a reversal. Now, basically, I've drawn the upper end of the trend lines, which are going to be the wall of resistance. And the S&P 500 on Friday expiration, it closed at 27.21. Now, the last high reversals that we had was when we bought the 27.50 puts over here. I'm going to draw up where that blue line is the 10-day simple moving average. Now, below there, we have the 100-day moving average. The red line is a 20-day moving average at 26.98. The longer-term daily price volatility rectangular consolidation setup, per se, is that this last week, that narrow range is a doji. Either gaps down and test support, and or it's going to gap up into resistance. But we can say beyond a reasonable doubt that this particular range, the S&P is only up maybe 2.2% for the year, and it hasn't been very favorable for markets. The price volatility is going to continue to be very strong. And I want to highlight that 50-day simple moving average on the daily here. That's that white line. Now, let me show you exactly why everything is very weak. That 50-day simple moving average has crossed over the 100-day. That's called the death cross. And it happened back over here in this time frame. That's the white line. Now, even though that we're getting rallies up and whatnot, that 50-day simple moving average mathematically continues to decline. And when you do the math between the 10-day and the 50-day simple moving average, the wider that mathematical setup between these two moving averages is not good for the bulls, because why is it that we're going to continue to sell off on any move up to higher resistance levels? We're going to roll over. Now, what I am going to do is I'm going to pull up the S&P 500 weekly chart right here. And it's a weekly chart. And I'm going to highlight the red line, which is the 20-week simple moving average at 27.10. The blue line that keeps falling in value, here's the deal, everyone. When you get a 10-week moving average crossing over the 20-week and still continues declining to go down, and the separation between the 10-week and the 20-week here mathematically is not good for the bulls. It's going to take some time for these things to work out. The price volatility for this calendar year, and we're about ready to go into what we call the June period, and the dog days of summer, that's when you get summer rallies and whatnot. But technically, the weekly chart is very damaging for the simple fact that that 10-week has not flattened out. Let me give an example of what I'm talking about with the 10-week moving average. The 10-week moving average, if you look over here, you see how that 10-week moving average was rising all the time until we put in the high? Well, that's what bull rallies are made of. Bull rallies are not made of the 10-week moving average going down in value mathematically. And that is right here. It crossed over the 20-week, and it crossed over there, and I can show you exact date and whatnot. And when we had that crossover, which was right here, that was on 4/1, April 1st, 2018. And we hit the 50-week moving average, which is still rising, but that's down here slightly above 2,600. And then within the actual weekly rally, that 50-week is rising. That's the only thing bullish about this particular setup. However, when we have this last week, we have a very narrow range day referred to as a weekly doji. Now, why is it that the S&P 500 is going to sell off at resistance when it goes up? It's because of that 20-week continues to go down in value. And that means you need to understand how the wall of resistance is going to happen on this S&P 500 index. Not only that, we will be buying put options on the S&P 500 index that can pay anywhere, depending on the volume. Let's say we have 10 contracts, we're going to get 30 points. That's a $30,000 trade. So the wall of resistance will remain up here. The top end at resistance levels are going to continue to sell down. The daily moving averages over here, yes, the 10-day crossed above the blue or beige line is 100-day. But the most relevant is when the 50-day crossed over the 10-day, the 20-day. That's going to be the weakness in this S&P 500. So you need to establish why stocks and or indexes are going to sell off at higher highs within the trend channel. So a lower high in the trend channel on any move higher is going to sell down. I conclude the S&P 500. Markets are going to open up tomorrow. We'll probably have a gap open up because today is Memorial Day. But the S&P 500 put options, super big payday.